One of the investments that I've talked about a little bit has been Patria Investments Limited, ticker symbol PAX. Now, I had an investment here largely because of their capital returns policy of returning a huge amount of their free cash flow through to the shareholders using a dividend. Now, that's obviously can be attractive if the company can continue to grow. Now, is it a growth company? I thought yes, and I continue to believe yes, it is a growth company. It's a private market investment firm focused on investing in Latin America. Now, this, for me, gives some geographic diversification, which is good to see. And they've had this fluctuating level of dividend payments with time. And I thought as they increase their earnings, the level of dividends would also increase as per their policy for distributing their profits to the shareholders. However, recent changes have been concerning me quite a bit. Now, this is from several weeks ago. It's their Q2 earnings call. And as we go through, they talk a bit about what they've been doing. Now, one of the really exciting elements of their approach that they've taken is they've started to make some other interesting investments, such as getting into REITs and real estate investment trusts. But what I wanted to do here in Q2 is really scroll down and look at this capital management strategy update. Now I'm just going to try and zoom in here a little bit. Before they dive into the results for the quarter and the expectations, they want to discuss this capital management strategy a little bit further. So they've determined an overall level of dividends for the year, resulting in a 15-cent dividend for the quarter, and it's going to be fixed at that level for the last 3 quarters of the year. Now, that itself isn't too concerning here, but they are announcing a share repurchase program of 1.8 million shares over the next 12 months. I think that's fundamentally is quite a nice idea. I think the shares are horribly undervalued at the moment. And so in terms of creating long-term shareholder value, I think that is a fantastic use of the capital. And that's essentially what they say in the next sentence as well. They believe the price doesn't reflect the long-term outlook. And also the other thing that they'll be looking to do is reduce the level of debt. And again, I think that's also a really important approach to take as well. I'm not entirely pleased though about the change to dividends, and if it was me personally, I would love to see that there is some indication or nod here to increasing the dividends over time, or some approach to increase the dividends as the earnings of the company increases. It doesn't have to be big. There's all sorts of different ways that they could distribute this capital. But they do note that even with the current stock price, the current yield is about 5%. It's not too bad. It's not too bad. Now, as a relatively new company here, there's not a lot of trading history, and we see the prices have been up at $22 a share and are now at about $11 a share or $12 a share. So not a lot of movement there. And we've also seen some pretty big swings in the earnings per share that they've reported. Now, long term, I would expect to see this company grow fairly quickly. And if we look at the normal multiple here of about 14 times, we could look at some very strong total annualized rates of return of about 40%. Now, even if it fails to hit that target and it's just trading here at about even 8 times on a price to earnings multiple, it could be looking at about 18% annualized rates of return. Now, what is going to get in the way of this? Well, partly that's also going to be depending on the dividend yield, and to be frank, I'm not sure that these estimates for the dividends are reasonable given the change in the capital management program for the company that they've talked about. We can also see that the earnings have been decreasing over the last 6 months, over all of these time frames. So analysts have been softening their expectations for the earnings growth. So whether or not this is a reasonable earnings target in the future, it's unsure, particularly here with next year with an expected increase of 40% of their earnings, and then after that another 15% in 2026. That is some very powerful earnings growth that we could capture by taking a position at this point. As I said, I'm a little bit disappointed about the change here in paying out less in dividends, but certainly a share buyback program could be very profitable, and repaying debt, and noting of course that they don't have a huge amount of debt here compared to the capital. I certainly can't argue with that long term. I'm just going to miss, I've got to be honest, I'm going to miss the dividends flowing in every quarter at the same level that they've done in the past. So yes, that's a downer. Is this still a good investment? If they can hit these growth targets here of earnings growth over time, much Aries management does, much like Apollo does, much like the other big companies, BAM, Brookfield Asset Management, this could be a very powerful growth story, even if the dividends are not as strong or as plentiful as they used to be. I think this could still be a long-term hold, just not necessarily a dividend growth investment as I was expecting it to be fundamentally in the long term. But look, strong growth of the earnings per share should lead to strong share growth, and that, my friends, should lead to some very nice gains. There is still, obviously, they will still be paying out a dividend as part of their capital management program. Let me know what you think. Does this change the capital management program? Does this fundamentally change your outlook on the company as an investment? Does this turn you off altogether? Or is this just a case of, we can still look at this for capital appreciation on top of the very nice income, which is still not too bad at about a 5% level with the current dividend payout plan? Let me know in the comments below, and my advice is watch this next video, because this is a video that YouTube thinks you would benefit from seeing.